What if one investment decision forced you back into work after you've already retired?
Not because you didn't save enough,
Not because you spent irresponsibly,
but because you borrowed money to invest.
and the debt outlived the investment. Lately, there's been a lot of online content and advice that's encouraged people to use debt to invest.
Advice like taking out another home mortgage or a HELOC in order to invest in the markets, or using margin to amplify returns, or advice like borrow cheaply now because the markets always win in the long term.
And most of this advice seems logical until things go wrong.
Before we go any further, let's make sure that we understand this.
This is not a recommendation to use debt to invest.
And this isn't about saying that those strategies never work.
It's about the risks that are often missing from the conversation, especially for everyday households and retirees. An advisor's job is not about finding the highest returns.
In part, it's about helping people avoid financial outcomes that can't be undone. So, Eddie, if borrowing in order to invest is so risky, then how come it sounds so enticing or convincing?
So these strategies are typically built on three basic ideas.
Okay.
One is something along the lines of, I'm going to borrow at a rate that's lower than what I can make in the market. So I'm going to make that difference. The second is that markets always go up over time, which historically is true, but we miss the timing element
Correct.
of that. And then that time can smooth out volatility. So it may be rough in the short term, but in the long term, it's kind of a smoother ride overall. And all three can be true.
But, that strategy can still fail badly.
Exactly.
The missing ingredient, I think, is flexibility. Because markets, they don't demand payments, but debt does.
And that's the most overlooked part of leverage.
So let's talk a little bit about what happens when you borrow to invest.
Okay. So when you borrow to invest, you absorb 100% of the downside.
Mm-hmm.
What I mean, when the markets go down, like typically you're not going to want to pull out the same amount of money or more money or anything like that, because the risk of running out of money goes way up. But you still owe money on that debt, and that payment's not going to change.
Right.
And so you're forced at that point to kind of pull out the same amount, or sometimes even more if you still got to maintain your lifestyle, whatever have you, if you're making withdrawals at that time. But even if you're not, you're still going to owe the bank. If that investment goes to zero, your debt's not going to zero. You're
Right.
still going to owe that money. So if you don't have a job, business, something like that, how are you going to pay that back?
That's
and
right.
then you only keep part of the upside, right? Because you're paying the debt.
Mm-hmm.
Those debt payments and the interest that you're paying on that debt has to be in the calculus for what your return actually is.
That's right. It's a real problem because if the markets perform poorly, the lender's still going to get paid.
That's right. That's right. And so you're still on the hook for all that debt, and you could lose your home or something like that.
Sounds good if it goes right, but if it goes poorly, it's bad.
Right. A market loss without debt is pretty uncomfortable, but if you have debt, it can be devastating.
Yeah, life-changing.
The fact is, debt forces timing.
That's right. Eddie, let's think about it this way. What is debt security called?
Bond.
It's a bond. It's a bond, right? Another way to say the word bond is to be bound. Another way to say it is to be in bondage. When you are in debt, you are in bondage, you are bound to that lender. And you are forced to repay that. And so when you're in debt, it takes away options. It takes away freedom. What does wealth really provide a person? It provides a person with the ability to choose what they do. What does debt do? Debt takes away that freedom. Debt forces the timing. This money is due now, and you have an outside force acting upon you to make you pay that debt.
Right. And so what if you do a risky strategy like that and say, we're going to talk about this in a minute, but you take a mortgage out on your house to buy some kind of investment. Well, everything may work out cash flow wise for you if everything stays peaches and roses. But if you have a hurricane come through, hurricane doesn't care that the market's down. We say that a lot, right. But hurricane doesn't care if the market's down. That debt, the bank doesn't care that the hurricane came through either. They're still going to demand that payment from you.
That's right.
Like you're saying, bondage. And so you could be forced out of your home and still owe a bunch of money at the same time. What kind of position would you be in?
We all have problems. Debt compounds problems.
Yeah. And this is where theory meets reality, especially in retirement.
That's right. Yeah, because in retirement, your income is less flexible. What do we say? Well, I'm on a fixed income. We hear that all the time. 2, your recovery time in retirement, it really just disappears. And in retirement, your tolerance for stress is reducing because you're no longer working. You no longer have an earned income. You're not putting money into those accounts. And so instead of adding to the fire, you're taking logs off of it. And so if you stress those accounts more, man, can you really absorb that kind of stress?
Yeah, well, and it's compounded, right? Because you don't have that income coming in from work anymore. And there's peace in that a little bit because now, at that point, your income is dependent on somebody else. Now it's dependent on this market that no one knows what's going to happen tomorrow with. I've seen situations before where, somebody's had to go back to work in retirement. They've become financially dependent. I've seen this in my own family, financially dependent on family members. Because they didn't do the prudent thing with their investing and everything.
How about somebody having to do this, sell their home in order to pay off those debts? And that's not because they were reckless necessarily, but it's likely because they really underestimated the consequential nature of leverage or borrowing in order to invest. When we talk about finances, a lot of times it can seem like we're talking about theory. But there are real-world consequences to these decisions. When theory is applied to real-world situations, there's consequences, and those consequences are deeply felt, and they impact people's lives. I've even heard of a man who was going into retirement, paid off his house, did a great job saving, putting money away so that when he went into retirement, he was going to be comfortable, probably most likely for the rest of his life.
Awesome.
Goes to his financial advisor, and his financial advisor says, hey, great, it's good that you paid off your house, you're going into retirement. And he said, hey, I can make you even more money. And here's how I'm going to do this. He said, I want you to go and take out a mortgage on the house that you just paid off.
What?
Yeah. Yeah, it's absurd. I want you to go take out a mortgage on the house that you just paid off, and if you will entrust me with $200,000 to $300,000, I can make you far more wealthy.
Dude, I mean, one, it's unethical to begin with.
Absolutely.
But at the end of the day, like, his broker dealers letting him do that?
It's astounding, isn't it? God. What happens? What happens when you put your home up for mortgage? You put your home in bondage to the lender. What happens if things fail? Well, this home investment, this shelter, has now become a tool of speculation, something that you depend on. You have just now put at tremendous risk.
Right. And at the end of the day, not only can you lose the home, but if the debt is higher than the amount that you got out of the house to begin, I mean, there is potential to be underwater on some of that, especially what if that area specifically is going through a housing downfall, something like that, and the house isn't worth as much as what you got the debt out for. I mean, you could be upside down.
Yeah, you're really uprooting your life in that kind of situation.
And debt isn't the only way that leverage shows up.
That's right. People want to participate in the options trades. They want to juice their returns.
Mm-hmm.
Why would somebody want to do that?
Well, I mean, they sound sophisticated.
It's very complex.
It sounds like you can control things there. And people use terms like income producing. And that sounds safe, but they don't really understand the underlying risk involved with it.
Yeah, these pursuits make it seem as though, if I'm smart enough, if I'm clever enough, I can milk this for all that it's worth. I can get ahead. I can outsmart. I can outtime the market. Yeah. And I can take this risk, and I can manage it.
And I'll tell you, I mean, when I was in my early 20s, I did some of this, right? This is one of the strategies, if you will, that kind of got me interested in the stock market to begin with, because it's like, man, I was 20 years old. I'm thinking, how can I get as rich as I can as fast as I can, right? And the stock market just seems slow, real slow. So I started studying options, and hey, I'll tell you, I've made trading options 25% in an hour before.
No. Must be for everybody then, huh?
No, I don't have any of that money anymore because I lost way more than I won on that, but I made 25% in an hour before.
I bet when you did that, you felt really smart and validated, but then when it all went away,
thank God I didn't have a lot of money back then.
Right.
I was dealing like $300 or something.
What is often missing in this is the understanding of what tail risk is. And it's exposing yourself to these outsized dangers and risks, to the extremes, really.
Yeah. And not to mention, but the more complex a strategy is, the harder it is to unwind.
That's right.
And when stress hits, that's exactly when you need the flexibility the most. Borrowing securities on margin doesn't wait for a recovery.
No.
When it's due, when margin comes calling, it's due.
Right.
It's like in that movie, Trading Places from the early 80s. I know you don't know anything about that. But that movie, that's how those two old men lost their rear ends. They were borrowing on margin. Margin came calling, and they were thrown out on the street.
When it comes to investing using debt, leverage, margin, there's something that happens where you really only ever hear from the winners.
Right. And there's an observation that I make. I call it the casino effect. I don't know if I made that up or I heard it somewhere, but the casino effect. So what is that? When someone goes to a casino and they come back, they normally don't tell you they went to the casino if they don't have a success story behind it. And so they'll come back and say, I won $100. I won $1,000. I won $10,000. But you never hear about how many times they went to the casino or how much money they spent in all of that time. I'm not just talking about one trip. All the times that they've gone to the casino, how much money did they spend to win the amount? So you might have won $10,000, but did you spend $30,000 to win the $10,000 over a course of 3 or 4 years?
Right.
That's the question.
Right. When these strategies do make sense for someone, I think we need to talk about the context that those folks are in, the kind of situations that those folks are in. How would you characterize someone in a situation where it could make sense?
If somebody's independently wealthy, right, they've got maybe several businesses, they've got different streams of revenue coming in from different areas, they've got plenty of time before they're ever going to need to touch the money they're investing.
Technically speaking, we call that high risk tolerance. They have the ability to absorb a loss. And if they're independently wealthy, they may have the ability to absorb a significant loss.
And for a retiree, most retirees, they need dependability and security so that they can get the withdrawals they need on a regular basis.
Right. Retirement is not the time for risk. It's the time for reliability. Initially, when you take out debt in order to invest, some of those risks don't show up immediately.
But when debt is placed into a strategy, an investment strategy, stress can really escalate.
That's right. That's right.
And financial stress compounds just like the stock market. And so we've talked a little bit about this before. We actually have a video, I'll link it in the description and try to remember to do that, that talks more in depth about how stress can affect your financial well-being, can affect your health. It can affect a bunch of different aspects of your life just from stress. But when stress goes up, good decision-making goes down, and it can unwind a whole batch of problems.
That's right. Financial stress can affect your health. It can affect your relationships, and it can take away your independence. I think there's probably a better way to think about risk.
Right.
Risk is not volatility.
Not by itself.
No.
So volatility is risky. It feels risky. It can cause stress when you don't understand it, if it's not part of your plan. But we take market risks, whether that's in the form of stocks, bonds, mutual funds, ETFs, whatever. We take that risk because there are certain things that are going to happen. We talk about that in other videos as well. But these other things like inflation, that's probably not going away. And if you don't take some form of risk in your portfolio, your spending power just erodes over time. And that's not a good place to be in. It might feel fine for a couple of years, but you get 10, 15 years down the road, things start getting really, really tight. And all of a sudden, the lifestyle you were hoping that you were going to live isn't there anymore. So volatility by itself can be a good thing if it's done properly.
Yeah, so risk, again, it's not just about volatility. Risk exposes you to losing the ability to make future choices.
Right. Future income, future flexibility. A plan that can be adjusted always will beat a strategy that has to be right to be successful.
In a deeper breakdown, we walk through how to stress test a financial plan against downturns, income changes, and unexpected life events before those risks become permanent.